They say that predicting the future is impossible, and usually I would agree, except when it comes to this week's Federal Reserve meeting, because I already know what's going to happen, and I'm going to tell you exactly that, so then you will already know what's going to happen. So let's do just that. As always, my name is Derek, and I got my degree in finance. You don't have to. Let's dive right in. So right off the bat, spoiler alert, the Federal Reserve is not going to cut their FFR, their federal funds rate. And I would love to call myself a genius and say that I somehow have a magic 8 ball, but everyone already knows this. And we can see that by looking at the CME Fed Watch tool. This is something that you should check out. It's free and it's online, and it shows you the likelihood of an FFR cut. And right now, the odds are sitting at 98% chance that there won't be a cut. And what does this mean? This means that there's virtually no chance that in a couple of days, the Federal Reserve is going to cut interest rates. And of course, then the question becomes, one, why? And secondly, how will this affect the market? Primarily the stock market, but I'm also going to talk about real estate as well because there is some carryover effect there. So first, let's answer the question, why? Well, simply put, because the data says that they shouldn't cut, both the economic data and the inflation data. So remember, the Federal Reserve has a target rate. This is usually 2%. Although I don't know if you're aware, but this 2% target rate was basically just said on live television by an economist named Roger Douglas in the 1980s, and it pretty much stuck. So that's where the target rate comes from. The point is, that is the target rate. And right now, inflation is not there. And even though last week's inflation report did come out better than expected, it's still not anywhere where it needs to be in order for them to cut. So CPI inflation last week came in at 2.8%. This is an improvement from 3% the previous month, but it's still not 2%. And secondly, core inflation, which the Federal Reserve cares about more, is still hovering at 3.1%. That is down from 3.3% last month, but it's still nowhere near the target rate. But it's really when you couple this together with the unemployment rate that virtually guarantees no cut. Because if inflation was coming down, but wasn't at its target rate yet, but also unemployment was skyrocketing, then the Federal Reserve may be more inclined to cut. The problem is the unemployment rate right now is sitting at 4.1%. which is creeping up. With that said though, 4.1%, historically speaking, is still extremely low. And it shows how solid, at least on paper. I know that in the real world, people are either struggling to find jobs or having to get multiple jobs to pay their bills, but on paper, unemployment is really good. And once again, the Federal Reserve, being data-driven, is going to look at this and say that there's no need to cut interest rates yet. And of course, their big fear is that if they cut interest rates too fast, inflation will continue to spike up. Because remember, they were cutting their interest rates for the last few months. And then what happened to inflation? Over the last 4 inflation reports until the most recent one, inflation was re-accelerating. So this is of course going to put the Federal Reserve on edge, and they're going to try to hold off cutting rates as long as possible. So there's your answer as to why there will not be a Federal Reserve interest rate cut this Wednesday at their meeting. And the next question, of course, is how will this affect the market? And I want to touch on 2 main areas. The first is the stock market, and next is real estate, because although not directly affected, it does have some carryover effect that is important to our lives as American consumers. So the stock market first. How is this going to affect the stock market? Well, it won't. And that's because the stock market likes to price things in. And this is already way priced in. The fact that the CME Fed Watch tool has a 98% chance that there's not going to be an interest rate cut, it means the stock market is already well aware of this, and it's already priced in. What actually would cause the stock market to move is if there were a surprise interest rate cut, because the likelihood is so small, this would likely send the stock market skyrocketing. Why? Well, because the stock market loves cheap money. It is hungry for cheap money, and cheap money always benefits the stock market. Why? Well, because it allows people to have more money to invest. Credit card loans are cheaper, which means people have to pay less into them, which means they can invest. Companies can borrow money, which means that they can grow faster. R&D can continue faster. And of course, growth is good for the stock market. Not only that, people can borrow money to fund their investment. So all in all, cheap money is good for the stock market. Now, of course, the likelihood of this is so minimal because it's basically not going to happen. But it is interesting to see that there's a potential trading play here because you basically have no real downside risk when it comes to this one event because it's already priced in. And if in the off chance they did cut rates, the market would probably go crazy. Although that's not financial advice, that's just my opinion. And we also need to not forget that the stock market is already extremely volatile right now because of Trump's economic policies, mainly tariffs. So there are other reasons why the stock market might move lower. And lastly, I want to touch on real estate, primarily mortgages. And that's because I think it's time to clarify something. There are some people who say that the federal funds rate does not affect mortgages, and that mortgages are more so affected by the 10-year Treasury. And while that is partially true, it's not true that the federal funds rate doesn't affect mortgages. The federal funds rate directly affects short-term borrowing costs. Correct. It doesn't directly affect the 10-year Treasury. But because it affects short-term borrowing costs, that in itself is going to trickle or ripple through the rest of the borrowing market. And you can actually see this in the 10-year Treasury and in mortgage rates. There is a correlation between FFR changes and changes in the 10-year Treasury. Usually the 10-year Treasury is roughly the FFR plus 1.5 to 2%. Now, of course, that's not the case right now, but usually that is the case. And then when it comes to mortgages, that's basically the 10-year Treasury plus, again, 1 to 1.5%. So while there isn't a direct correlation, there is an effect on mortgages by the FFR. And if you want to buy a home, you probably want lower priced mortgages. And we're not going to get those lower priced mortgages or lower interest rate mortgages until we get a change in the FFR, which unfortunately doesn't seem like it's going to really happen in a noticeable way this year. Mortgage rates will continue to come down, but it won't be significant for some time. And this also has another ripple effect when it comes to real estate, and that is in home prices. Because guess who also relies on loans to be able to create homes? Home builders. And while there was an uptick in home builds, which of course adds supply, which helps the housing crisis that we have right now, because there's been a pause in federal funds rate cuts, there's also been a significant slowdown in added supply by home builders, which once again, if you want to purchase a home and you're waiting for supply to tick up so home prices are a little more affordable, that unfortunately is going to take some time as well. And that's simply because if I'm a home builder and I have a higher cost on my loan, I have to also charge more for the homes that I'm selling to be able to recoup that cost and still make a profit. Now, when do I foresee this changing? I mean, we're talking a year plus out. The housing market has been a major thorn in pretty much every American side since 2020. And while it hasn't been as bad, and I don't foresee the housing market to go crazy this year, it's still insanely expensive to buy a home. And unfortunately, that's not going to change anytime soon. And it especially won't change until we get cuts, major cuts in the FFR. So there you have it. Now you can also predict the future and you know exactly what's going to happen at Wednesday's Federal Reserve meeting. And of course, it'll be interesting to look back at this video on Wednesday to see if it was true. And obviously, if it wasn't true, that'll be a major shock and I will make an update. But for all intents and purposes, this is what's going to happen. I hope this video was fun and informative. If it was, please consider subscribing. It helps out the channel tremendously. And if you like personal finance, world economics, and investing broken down simply, you are in the right place. So I hope to see you in the next video. Until then, take care.